Hello again, this is Sarah. Hello. Now we're going to explain the inventory evaluation. Okay. First, I have this Excel that clarifies the concept of the inventory evaluation in a clear way. When I write NRV, that means that's the net realizable value. If the net realizable value, it's not given to you the day of the exams, you can simply calculate it by subtracting the cost to complete the sales or disposal of the inventory from the selling price. Okay, so NRV, net realizable value, that's selling price minus cost to complete the sale or disposal of the inventory. Whenever you see net in accounting, that means there's a minus figure. Okay, so when I say net accounts receivable, that's the AR minus the allowance. Net realizable value, that's the selling price minus cost to complete the sale or the disposal of the inventory. If you are using the Fifo, first in, first out, or the weighted average method, then you have to apply lower of cost or net realizable value. I'm going to give you a great exercise in a few minutes. So if you are using Fifo or the weighted average, then you have to apply this rule. The inventory evaluation is based on the lower of cost or net realizable value. If you are using LIFO, last in, first out, okay, which is prohibited, by the way, under IFRS, or the retail method, then the inventory evaluation is based on the lower of cost or market. When I say market, okay, that's the value in the middle. So remember, market, that's the value in the middle. The value in the middle by comparing three things: the replacement cost, which will be given to you, the net realizable value, which might be given to you, and in case it's not given to you, you can simply calculate it by subtracting the cost to complete the sale or disposal of the inventory from the selling price. It's also called the ceiling, okay, and the floor, which is the difference between the net realizable value and the normal profit margin. So that's N minus N, that's the floor. Net realizable value minus normal profit margin. I'm going to give you a great exercise, but while you solve similar questions, you have to pay attention. Am I applying or am I using Fifo, weighted average, LIFO, or retail method? Okay, if I'm using Fifo or weighted average, then I have to apply the lower of cost or net realizable value. If I'm using LIFO or the retail, I have to apply the lower of cost or market. So that's a great example. I'm gonna give you 4 items, A, B, C, and D. Also, the cost is given to you, the replacement cost is given to you, the selling price is given to you, the cost to complete the sale or disposal of the inventory, and the normal profit is given to you. Now, the requirement is to evaluate the inventory under LIFO and Fifo. Remember, if you are using LIFO, then you have to apply the lower of cost or market. That's the rule. Okay, so I have to compare the cost with the market and pick the lower amount. Okay, item A, for example, the cost is $102. The replacement cost is also given to us, $95. The selling price, that's $125. The cost to complete the sales, that's $5. The normal profit is $30. We have first to calculate the market. As I said before, market, that's the value in the middle, okay? You have to compare 3 columns: the replacement cost, the net realizable value or ceiling, and the floor. The replacement cost that's given to us, it's $95. The net realizable value, it's not given to us, but I know that net realizable value, net is minus figure, that's the selling price minus cost to complete the sale. So if I double click this cell, that's the difference between $125, the selling price, and $5, the cost to complete the sale. So that's $120. What about the floor? The floor, that's N minus N, the net realizable value minus the normal profit. Okay, so that's the 120 minus the $30 normal profit, that's equal to $90. I'm gonna double click this, and that's the difference between the net realizable value and the normal profit. Now, sometimes they don't tell you that the normal profit is $30. They just tell you that the normal profit is 24%. And the student starts thinking 24% of what? Definitely that's a normal profit. That means it's 24% of the selling price. So in case they don't give you the normal profit as a dollar amount, they give you the normal profit as a percentage, then to calculate the normal profit in dollars, you have to multiply the percentage, 24%, by the selling price, which is $125 in this case. So that will be equal to $30. Okay, so that was the first example. We calculated the net realizable value, the floor, and we have the replacement cost. Now order these three numbers in a descendant way or in ascending way. Okay, so first I have 90, then 95, then 120, or I have 120, then 95, then 90. So the value in the middle is simply the 95. Now, the value in the middle, that's the market value. So the market is $95. I have to compare it with the cost of 102, which is the lowest amount, that's $95. So that's the lower of cost or market. Item A, that's $95. For item B, I do the same. Okay, you have the table here and you have the solution. Try to do it on your own. It's very easy. Just apply the rule and you will be on the safe side. The second one, that's FIFO. Now with FIFO, it's a bit different. Okay, the rule is different. We're no longer using lower of cost or market. No. With FIFO, that's the lower of cost or net realizable value only. So you just have to compare the cost with the net realizable value. And you know, the net realizable value or the ceiling, if it's not given to you the day of the exam, that's simply the difference between the selling price and the cost to complete the sale. So you compare, for example, 102 with 120. What's the lowest? That's 102. So item A, that's 102. 130 versus 140. 130 is less than 140. So 130 is the inventory valuation of item B. That was everything when it comes to the inventory valuation. I hope you enjoyed the video. Thank you so much for watching.